Something big just happened with YAI stock, and honestly, it's one of those moments that makes every investor stop and look twice. The company just pulled off a 1-for-50 reverse split right after its stock got crushed by more than 50% in a single day. Think about that for a second. You wake up, check your portfolio, and half of your investment value is gone overnight. Then the company says, "We're doing a 1-for-50 reverse split." Yeah. That's the kind of move that makes the entire market start asking, what's really going on here? Now, before we go any deeper, quick disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor, and none of this is financial advice. Always do your own research before making any investing decision. All right, so what's really happening with YYAI? The company's decision to consolidate every 50 shares into one wasn't random. It's mainly a survival tactic. NASDAQ has a rule that every stock must stay above $1 to keep its listing. And when YYAI's price fell below that level, they had two choices: risk being delisted or pull off a massive reverse split to push that price back up. On paper, it sounds like a fix, but here's the truth. It's not a sign of strength. It's a compliance move, something companies do to buy themselves time, not to show real progress. And that's why the market reacted exactly how you'd expect, with a huge sell-off. Investors saw right through it. After the reverse split, the total number of outstanding shares dropped from nearly 1 billion to just about 19 million. That looks cleaner, sure, but it also comes with trade-offs. Lower share count usually means lower liquidity. It becomes harder for regular investors to trade in and out easily, and that volatility can actually increase. They also rounded fractional shares up to whole numbers to avoid weird leftover positions. But let's be honest, that's cosmetic. It doesn't fix the deeper problem. The bigger story here isn't the split itself, it's that management went straight for the maximum ratio they were allowed. A 1-for-50 split isn't something companies do lightly. It screams urgency. It's a message that says, we're running out of room. And when you look at the financial backdrop, you start to see why. YAI's revenue has fallen by over 90% in the past 3 years. That's not a typo. 90%. Profitability remains negative, and financial risk models show the company sitting right inside what analysts call the distress zone. Now, that doesn't automatically mean bankruptcy is around the corner, but it does mean the company's financial health is weak, and investors know it. One of the biggest red flags for me is the ownership structure. Insiders own a massive chunk of the shares, but institutional ownership, meaning big funds or mutuals, is extremely low. That's not a great mix. When institutions stay away, it usually signals one thing: the smart money doesn't trust the long-term story yet. Now, to be fair, the company isn't just sitting still. YYAI has been trying to reinvent itself through its ARWA exchange, a project focused on tokenization of real-world assets. And that's a huge trend right now. Basically, tokenization means turning physical or traditional assets like stocks, real estate, or private credit into digital tokens on the blockchain. It's a concept that could redefine finance over the next decade. ARWA wants to be part of that wave. They've got a joint venture with Jucoin Capital valued around $250 million. That sounds impressive, and it does show there's some serious backing behind the idea. But it also creates risk. Jucoin is now heavily exposed to YAI's success. If the ARWA exchange fails to attract users or revenue, Jucoin's investment could backfire hard. Then there's their partnership with Solana, one of the biggest blockchain ecosystems. That adds another layer of attention and pressure. Because if ARWA's exchange stumbles, it doesn't just hurt YI, it could even put a small dent in Solana's own tokenization momentum. Now, let's zoom out for a second and look at the bigger picture. The tokenization market isn't just hype. Big players like BlackRock and JP Morgan are already exploring it. Some analysts believe this market could grow into the trillions over the next decade. So yes, the opportunity is real. But YYAI's position is complicated because they're trying to compete in a space already dominated by powerful names like Securitize and Polymath. These companies are better funded, have stronger reputations, and already have institutional trust. That means if YYAI can't move fast, can't show real user traction, or can't bring in consistent revenue, investors and customers will just move toward those established players. And that's where the danger lies. The reverse split might give YYAI a little breathing room, but it doesn't fix their business fundamentals. It just delays the pressure. Now let's talk about sentiment. Investor confidence is shaky. Social media discussions, Reddit threads, even institutional commentary, most of it paints YYA as speculative, a short-term trading play, not a stable long-term investment. The company will have to do something dramatic to change that narrative. What would that look like? First, they'd need to prove that the ARWA exchange actually works, that people are using it, and that it's generating real, sustainable revenue. Second, they'd have to show that regulators are on board, because tokenization in the US can get messy if compliance isn't airtight. And third, they'd need to rebuild credibility with investors, not just through flashy partnerships, but through consistent execution quarter after quarter. Without that, I think the company stays in high-risk territory. There's even the chance that if things don't improve, they could face more delisting pressure, or worse, another sharp drop in price that wipes out remaining investor confidence. But on the flip side, if they can deliver results, if ARWA gains traction, and if they can align with the right partners, there's a small but real chance this story could flip. The tokenization market is enormous, and being early does have advantages. The question is whether YYAI can survive long enough to see that future. To me, this whole story feels like a cautionary tale, a reminder that not every AI or blockchain label equals opportunity. The fundamentals still matter, revenue matters, execution matters, and no reverse split can hide that. In my opinion, YYAI's reverse split isn't a comeback story. It's a survival move, a temporary fix to meet Nasdaq's listing rules. The real test starts now, and it'll all come down to whether the ARWA exchange can actually deliver something meaningful. So if you're watching this as an investor, take the hype with a grain of salt. Pay attention to the next earnings report. Look at the real numbers, because at the end of the day, the market doesn't reward big promises, it rewards results. Now I'm curious, what do you think? Is YYAI a bold turnaround play in a trillion-dollar market, or just another struggling company trying to buy time? Drop your thoughts down below. And if you found this breakdown helpful, make sure to hit the like button, subscribe for more stock analysis, and stay tuned, because the next few months could decide everything for this company.